Most influential. Luke-Jr. By Jamie Crawley. The veteran Bitcoin developer is at the forefront of one of the most hotly discussed debates in crypto: what the original blockchain network should be used for. Veteran Bitcoin developer Luke-Jr. is at the forefront of one of the most hotly discussed debates in cryptocurrency: what the original blockchain network should be used for. The advent of the Ordinals protocol in 2023, which allowed a form of NFTs to be minted on Bitcoin, and Runes a year later, which did something similar for fungible tokens, prompted calls from a number of voices, few as prominent as Dash Jr.'s, that they bring unnecessary spam to the Bitcoin network, distracting it from its core mission. This feature is a part of CoinDesk's most influential 2025 list. Dash Jr.'s resume includes helping fix Bitcoin's accidental hard fork in 2013 and maintaining the alternative Bitcoin knots, giving him status as a venerable developer and commentator who warns against allowing a proliferation of non-financial transactions on Bitcoin. This forms part of the controversy around the proposed changes to the blockchain's op_return, removing the 80-byte cap on data that can be attached to transactions via inscriptions. Dash Jr. called this utter insanity, warning that loosening data restrictions would clog up the network with what he calls spam and detract Bitcoin from its core purpose as decentralized digital money. Dash Jr.'s critics, however, argue that his vision of Bitcoin requires compromising its principle of immutability. Ocean, the Jack Dorsey-backed mining pool of which Dash Jr. is a founder, has declined to process some inscription transactions. Such debates will continue into 2026 and beyond, and it is likely that Luke-Jr. will remain one of the most prominent voices in them. As of October 2025, GoPlus has generated $4.7 million in total revenue across its product lines. The GoPlus app is the primary revenue driver, contributing $2.5 million, approximately 53%, followed by the Safe Token protocol at $1.7 million. GoPlus Intelligence's token security API averaged 717 million monthly calls year-to-date in 2025, with a peak of nearly 1 billion calls in February 2025. Total blockchain-level requests, including transaction simulations, averaged an additional 350 million per month since its January 2025 launch. The $GPS token has registered over $5 billion in total spot volume and $10 billion in derivatives volume in 2025. Monthly spot volume peaked in March 2025 at over $1.1 billion, while derivatives volume peaked the same month at over $4 billion. Latest BTC bull turns bear. Jurrien Timmer warns of year-long crypto winter. By James Van Straten. Fidelity's global macro director, Jurrien Timmer, has called the end of the latest Bitcoin bull run, while highlighting gold's continued bull market strength. Fidelity's global macro director, Jurrien Timmer, says Bitcoin's October peak near $125,000 aligns closely with prior four-year cycles in both price and time. Timmer suggests 2026 could be a year off for Bitcoin, with key support seen between $65,000 and $75,000. Timmer contrasts Bitcoin's recent weakness with gold's strong 2025 performance, noting gold is behaving as expected in a bull market by holding on to most of its gains during its latest correction. Jurrien Timmer, director of global macro at Fidelity and a longtime Bitcoin bull, has become one of the latest financial strategists to turn more bearish on Bitcoin BTC $88,172. Citing the asset's 4-year cycle, Bitcoin has historically followed a repeatable pattern. And from both an analog and time-based perspective, the current cycle appears to be aligning closely with prior ones. Timmer argues, the October all-time high near $125,000, reached after roughly 145 months of cumulative rallying, fits well within the framework. Bitcoin bear markets, often referred to as winters, typically last about a year, Timmer says. As a result, he sees $2026 as a potential year off for Bitcoin following the conclusion of the latest halving-driven cycle. While I remain a secular bull on Bitcoin, my concern is that Bitcoin may well have ended another 4-year cycle halving phase, both in price and time, Timmer wrote on X. If we visually line up all the bull markets, we can see that the October high of $125,000 after 145 months of rallying fits pretty well with what one might expect. Bitcoin winters have lasted about a year, so my sense is that $2026 could be a year off for Bitcoin. Support is at $65,000 to $75,000. Timmer also highlights gold's strong performance in $2025, contrasting it with Bitcoin's negative year, and does not expect a near-term mean reversion between the two assets. Gold is firmly in a bull market, up roughly 65% year-to-date, outperforming global money supply growth, Timmer noted. He adds that during the recent correction, gold has held onto most of its gains, which he views as characteristic behavior of a bull market. Metaplanet, $3,350. To start sponsored ADR program to woo over-the-counter U.S. investors. By James Van Straten. AI Boost. The sponsored Level 1 ADR listing strengthens U.S. investor access, settlement quality and market credibility, the company said. Metaplanet's sponsored Level 1 ADRs will trade over the counter under the ticker MPJPY starting Dec. 19. The ADRs will offer U.S. dollar settlement, improved liquidity and standardized U.S. market infrastructure without raising new capital. Metaplanet shares rose 6% in Tokyo trading to 443 yen, $2.80. Japanese Bitcoin treasury company Metaplanet, $3,350, said its American depository receipts, ADRs, will start trading Dec. 19 on the U.S. over-the-counter OTC market under the ticker MPJPY. The securities are designed to improve access, transparency and operational efficiency for U.S.-based investors in the fourth-largest corporate holder of Bitcoin BTC $88,172. They will replace existing, unsponsored OTC trading under the MTPLF ticker, which lacked a formal deposit agreement and direct company involvement. The ADRs meet Level 1 issuance standards, meaning they are subject to the lowest level of compliance and regulation and cannot trade on regulated exchanges. Each ADR represents one common share and settles through standard U.S. securities infrastructure. Deutsche Bank Trust Company Americas will act as depositary, with MUFG Bank serving as custodian in Japan. The program is not intended for capital raising and does not affect the company's total shares outstanding. Even though the ADRs are limited to OTC trading rather than on NASDAQ or the NYSE, they offer materially improved settlement, much broader brokerage access and significantly lower trading fees than unsponsored OTC instruments. Dylan LeClaire, head of Bitcoin strategy at the Tokyo-based company, said in a post on X, The structure removes key barriers for both retail and institutional investors, many of whom require compliant ADR frameworks due to regulatory and custodial mandates. He said, Metaplanet shares rose more than 6% in Tokyo to 443 yen, $2.80. Bitcoin, BTC, jumps above $87,000. Yen slides as Bank of Japan hikes rates by 25 basis points. By Omkar Godbal, the Bank of Japan raised its short-term policy rate by 25 basis points to 0.75%, the highest in nearly 30 years. The Bank of Japan raised its short-term policy rate by 25 basis points to 0.75%, the highest in nearly 30 years. Despite the rate hike, the Japanese yen fell against the US dollar, while Bitcoin saw a slight increase in value. Market reactions were muted as the rate hike was anticipated, with speculators already holding long positions in the yen. Bitcoin BTC $88,020 strengthened as the Japanese yen dropped after the Bank of Japan (BOJ) hiked interest rates as expected. The Japanese central bank raised its short-term policy rate by 25 basis points to 0.75%, the highest level in roughly 3 decades, continuing the gradual shift away from decades of ultra-loose monetary policy. In the policy statement, BOJ acknowledged that inflation has held above its 2% target for an extended period due to rising import costs and firmer domestic price dynamics. However, policymakers emphasized that interest rates adjusted for inflation remain negative, implying that monetary conditions are still accommodative even after the hike. The Japanese yen slipped to 156.03 per US dollar from 155.67 following the rate decision. Bitcoin, the leading cryptocurrency by market value, rose from $86,000 to $87,500 before, pulling back slightly to trade near $87,000 at press time. CoinDesk data show the market reaction aligns with expectations, as the rate hike had been widely anticipated. Furthermore, speculators had held long positions in the Japanese yen for weeks, preventing any sharp yen buying response after the announcement. In recent weeks, some observers had expressed concerns that the rate hike could strengthen the yen, triggering an unwinding of yen carry trades and a broad-based risk-off sentiment. For decades, Japan's ultra-low or even negative interest rates made the yen a preferred funding currency for carry trades. Investors borrowed cheaply in yen to invest in higher-yielding assets, including the U.S. tech stocks, treasury notes and emerging market bonds, amplifying global liquidity and risk appetite. This strategy thrived as long as Japan's rates stayed pinned near zero, effectively turning the yen into a key enabler of leverage and risk-taking across global financial markets. So, the prospects of higher rates in Japan scared risk asset bulls. These fears, however, were overblown, as CoinDesk explained, noting that even after the rate hike, Japanese rates would remain notably cheaper than their U.S. counterparts, ensuring there is no mass unwinding of carry trades. Bitcoin price, BTC, analysis. At least one metric remains at a record high. By James Van Straten. A very supportive macro backdrop is being ignored for now, said Bitwise's Andre Dragosh. Bitcoin's so-called realized capitalization is at a record $1.125 trillion, continuing to rise through this recent 36% price correction. Bitwise's Andre Dragosh argues Bitcoin is underpricing a supportive macro backdrop, with resilient growth and a more dovish Fed potentially driving further upside and undermining the four-year cycle framework. Bitcoin's realized capitalization is at an all-time high of $1.125 trillion, suggesting that BTC remains in a bull market despite the NEAR 40% plunge in prices over the past 10 weeks. This on-chain metric, which values each Bitcoin at the price it last moved, highlights actual capital inflows rather than speculative price action like total market capitalization. Glassnode data shows realized cap continued to rise through the 36% correction from the October all-time price high, even as it stalled of late in the $1.125 trillion area. A similar pause was seen during the tariff tantrum in April 2025, when Bitcoin bottomed near $76,000 before going on to make new highs. During the 2022 bear market, realized cap fell from around $470 billion to $385 billion as investors capitulated and coins were sold at lower cost base. This sort of response is not being seen at the moment. Four-year cycle narrative questioned. Andrei Dragosh, European head of research at Bitwise, told CoinDesk that Bitcoin could defy the four-year cycle narrative, with upside surprises in 2026. Dragosh pointed to resilient global growth combining with ongoing rate cuts to steepen the yield curve and expand liquidity, all conditions that could weaken the US dollar, which is an environment that has historically been supportive for Bitcoin. In my view, Bitcoin is materially underpricing the prevailing macro backdrop, to a degree last seen during the COVID recession and the FTX collapse. Despite no signs of a US Bitcoin, BTC, price news. BTC quickly gives up advance above $89,000. By Christian Sandor, Helena Braun. Far softer than expected inflation numbers Thursday morning had markets racing early. But some are questioning the data. In what's now become a regular occurrence during this bear market, crypto markets swung from sizable gains to sizable losses in a very short time frame. Bitcoin early in U.S. action Thursday had popped above $89,000 after a far softer than forecast CPI print initially raised hopes for easier Fed monetary policy. Though well off session highs, equity markets remain nicely in the green for day, continuing their 2025 pattern of outperforming crypto. To the dismay of the bulls, crypto markets continued with their whipsawing action again on Thursday, with large early gains being more than reversed over a very short time frame, happening over a period of a couple of hours as opposed to yesterday's couple of minutes. The size of today's reversal was nearly as large, with leading crypto Bitcoin BTC $88,017 slumping from a session high of $89,300 to as low as $85,500. At press time, BTC was changing hands at $86,000, lower by 0.8% over the past 24 hours. The Nasdaq was off session highs of about 2%, but still sharply ahead with a 1.7% advance. The early gains came alongside a much cooler than forecast November U.S. Consumer Price Index report, with headline inflation tumbling all the way to 2.7% from 3% previously. That data had some quickly penciling in another Federal Reserve rate cut in January, which, all things being equal, would tend to be good for risk assets, including crypto. Skeptics, however, quickly dove into the outlier inflation numbers. Major issue was zeroing out rent owners' equivalent rent, OER, in October, wrote well-followed economist Omer Sharif. Unless the BLS adjusts, he continued, it will artificially lower year-over-year CPI prints until April. This is totally inexcusable, wrote the WSJ's Nick Tamiraus. The BLS just assumed rent OER were zero for October. There is just no world in which this was a good idea. At the moment, markets appear to be agreeing with the skeptics, with odds of a January rate cut not having budged from their previous slim 24% chance. BTC range-bound. ETH hedging. Traders in the crypto options market appear to be adjusting their expectations, with Bitcoin and Ether ETH $2,982 showing diverging sentiment. According to data from Wintermute, Bitcoin options activity points to a range-bound outlook as traders continue to sell downside protection below $85,000 and cap upside exposure above $100,000. This is pointing to confidence in support holding and limited expectations for a sustained breakout in the near term, the market maker's OTC trading desk wrote in a note. Ether options, by contrast, show less conviction and more hedging behavior. Support appears to be forming around the $2,700 to $2,800 range, but upside calls above $3,100 are being sold aggressively, suggesting traders are seeking protection over upside. CF Benchmarks views Bitcoin as portfolio staple. Projects $1.4 million price target by $2,035. By Siamak Masnavi. AI Boost. CF Benchmarks outlines long-term Bitcoin valuation scenarios through $2,035, including a bear case near $637,000. As institutions apply portfolio models to crypto, CF Benchmarks applies traditional capital market assumptions to Bitcoin for institutional investment. The framework derives bear, base and bull price scenarios through $2,035. The analysis argues that Bitcoin can improve portfolio efficiency at modest allocation levels. CF Benchmarks, a wholly owned subsidiary of Kraken, stated on Thursday that institutional investors are increasingly analyzing Bitcoin BTC $88,017 through the lens of portfolio construction rather than short-term price cycles. The firm models a base case price of $1.4 million by $2,035. In its 42-page report, titled Building Bitcoin Capital Market Assumptions, a Practitioner's Framework for Strategic and Tactical Allocations, the UK-based FCA-regulated benchmark administrator argued that Bitcoin can be evaluated using the same capital market assumptions applied to traditional assets, including expected returns, volatility and correlations. That shift reflects growing institutional participation as regulated markets become accessible, deeper liquidity in spot and derivatives markets, and improving regulatory clarity. According to the firm, a portfolio-based approach to Bitcoin, instead of offering near-term price calls, CF Benchmarks applies multiple valuation frameworks to assess Bitcoin's long-term role in diversified portfolios. Those models include comparative valuation against other stores of value, production economics that link market price to mining costs, and analysis of Bitcoin's sensitivity to global liquidity conditions. Taken together, CF Benchmarks said these approaches suggest Bitcoin's value is supported by its expanding share of the global store of value market, its fixed supply schedule, and its responsiveness to monetary conditions. As institutional participation increases, the firm anticipates that volatility will decline over time, while correlations with traditional asset classes remain relatively low, thereby enhancing diversification potential. Long-term price scenarios through $2,035. Using those frameworks, CF Benchmarks derived a range of long-term valuation outcomes for Bitcoin through $2,035, based on differing adoption paths. In its most conservative scenario, The firm modeled a bear case in which Bitcoin continues to gain market share at its historical pace, capturing roughly 16% to 33% of gold's market capitalization. Under that scenario, CF Benchmarks estimated a Bitcoin price of about $637,000 by $2,035. Its base case assumes broader institutional adoption and faster growth, with Bitcoin reaching roughly one-third of gold's market capitalization. That probability-weighted scenario implies a price of around $1.42 million by 2030. $5. According to the report, in a more optimistic bull case, CF Benchmarks modeled Bitcoin becoming the dominant global store of value, surpassing gold's market capitalization. That scenario projected a valuation of nearly $2.95 million by 2035, driven by accelerated institutional and sovereign adoption. Implications for institutional portfolios. Beyond price outcomes, CF Benchmarks said its simulations suggest a strategic allocation of roughly 2% to 5% to Bitcoin could meaningfully improve portfolio efficiency. In those models, Bitcoin's high expected returns, declining volatility, and low correlations with equities and bonds expanded the efficient frontier, allowing for higher return targets at comparable or lower levels of risk. The firm argued that as regulatory clarity improves and institutional access deepens, investors are likely to focus less on speculative narratives and more on disciplined allocation, rebalancing, and risk management frameworks. Rather than treating Bitcoin as an outlier asset, CF Benchmarks analysis positions it as an asset that can be increasingly modeled to be a component of long-term portfolios, with valuation outcomes tied to adoption dynamics and macroeconomic conditions rather than short-term market sentiment. Bitcoin price analysis. BTC headed lower as metals soar. By Christian Sandor. JP Morgan analysts in October said investors betting on currency devaluation would lift precious metals and Bitcoin, but only one of those trades has worked. Bitcoin's price dropped 30% from its October record while gold and silver rally. Analysts suggest Bitcoin's weakness is linked to its association with risky assets and structural selling by long-term holders. Historical trends indicate BTC could rally after gold's peak, with a potential catch-up expected in 2026. Bitcoin's BTC $87,164 stark rejection at $90,000 on Wednesday was a quick reminder for investors that precious metals like gold and silver are the real winners of the debasement trade, not, at least for the moment, digital gold. Back in October, JP Morgan analysts said that gold and Bitcoin were both benefiting and would continue to benefit from the so-called debasement trade. They projected BTC to follow gold's lead, putting a $165,000 BTC price target on a volatility-adjusted basis relative to gold. So far, that thesis hasn't played out. While BTC is languishing around $88,000, down 30% from its early October record, gold is trading near record highs around $4,350 an ounce, and silver Wednesday hit fresh all-time highs above $66, up 40% since October. Bitcoiners can't ignore the bull market in precious metals, which continues to roar, said Charlie Morris, founder of ByteTree. Why is BTC lagging? Bitcoin's current weakness stems from its linkage to risky assets, Morris wrote in a Wednesday report. While stock indices have been hovering near record highs, the most speculative pockets of the equity market, data centers and artificial intelligence, infrastructure bets and recent IPO names, saw heavy drawdowns over the past few weeks. There's also a technical element behind Bitcoin's relative weakness to gold. The BTC gold ratio already peaked in late 2024 and is deep into a bear market, tumbling over 50%. In August, BTC gold made a lower high, pointing to fading momentum, and since then has rolled over, making a fresh low on Wednesday and its weakest level in almost 2 years. Structural selling from long-term holders has also added to Bitcoin's weakness. Research from Vettel Lundy, head of research at K33, noted that BTC supply held in UTXOs, unspent transaction outputs, older than 2 years has been in a persistent decline, with roughly 1.6 million BTC reactivated since 2024. Separately, Glassnode data also shows that long-term investors have ramped up selling their holdings. This represents on-chain evidence of substantial, sustained selling pressure from long-term holders, Lundy said. There's also growing discussion around the risks quantum computing poses to Bitcoin's cryptographic security. While the concern remains largely theoretical, it has added a layer of uncertainty for investors. Analyst, silver rally could set stage for BTC. The silver lining, no pun intended, for Bitcoin investors is that BTC should eventually take the baton from gold as the yellow metals rally cools. Historical patterns show that gold peaks often precede BTC rallies by 100 to 150 trading days. Bitfinex analysts pointed out, they said that Bitcoin's current market consolidation is a transitional phase, laying the groundwork for a catch-up in 2026. ByteTree's Morris expressed a similar view. I remain bullish on silver, but it won't go on forever, Morris said. I suspect that when the rally runs out of steam, Bitcoin will step in. Bitcoin price. BTC news. BTC adds to gains after soft inflation numbers. By James Van Straten. Bitcoin shot above $88,000 as forecasts had been for inflation to continue to run above 3%. November CPI was higher by 2.7% against forecasts for 3.1%. The core rate fell to 2.6% versus expectations for 3%. Bitcoin added to early gains on the news. U.S. inflation data surprised to the downside on Thursday, potentially setting up the economy for continued Federal Reserve rate cuts next year. The Consumer Price Index, CPI, rose 2.7% on a year-over-year basis in November, according to a Thursday report from the Bureau of Labor Statistics. Economist expectations had been for a rise of 3.1% and the previous read was 3%. Core CPI, which excludes food and energy, rose 2.6% against forecasts for 3% and 3% previously. Monthly data was not included as the BLS statisticians continue to suffer the effects of October's government shutdown. Market reaction was swift, with Bitcoin BTC $87,184 adding about 0.5% to earlier gains, now trading back above $88,000. U.S. stock index futures also added to earlier gains. The Nasdaq 100 now ahead by 1.15%. The 10-year Treasury yield slipped 2 basis points to 4.12%. Ahead of the data, markets were pricing in a 73% probability that the Federal Reserve would leave interest rates unchanged at its January meeting. According to the CME Fed Watch tool, these softer inflation numbers, though, could change that calculus and, for the moment, risk markets, crypto among them, are moving higher on the chance of easier than forecast monetary policy. Micron crushes earnings, helping BTC stay buoyant above $87,000. By James Van Straten. Micron earnings shock triggered a broader risk rebound, with QQQ up nearly 1% pre-market and Bitcoin holding above $87,000. Micron Technologies posted a major upside surprise, reporting Q1 2026 revenue of $13.6 billion, up 57% year-on-year. Micron earnings shock triggered a broader risk rebound, with QQQ up nearly 1% pre-market and Bitcoin holding above $87,000. From "it's so over" to "we're so back" market sentiment flips fast these days on social media. Just days after AI bubble fears resurfaced, Micron, a critical supplier of memory chips used in AI infrastructure and data centers, has posted blowout earnings, reversing the bearish sentiment. This led to U.S. technology futures trading up in pre-market on Thursday, with the Invesco QQQ up nearly 1% pre-market after falling almost 2% on Wednesday. Bitcoin, too, has stabilized above $87,000 following its wild swings in both directions on Wednesday. BTC and tech stocks tend to move in lockstep, with the AI boom at the center of the positive correlation since late 2022. According to the latest earnings report, Micron reported Q1 2026 revenue of $13.6 billion, a 57% year-over-year increase. Gross margins surged to 56%, compared with 38% a year earlier, while operating income jumped to $6.1 billion. Net income reached $5.24 billion, nearly triple last year's level, with diluted EPS of $4.60, beating Wall Street's estimate of $3.96. According to FactSet data, AI-driven demand was the standout theme. Micron's cloud memory business unit saw revenue double year-on-year, while mobile and client revenue rose 63%, according to an earnings presentation. According to the conference call, the firm now forecasts Q2 2026 revenue of $18 to $19 billion, which is above the expectation of $17.8 billion. According to FactSet data, the management also said that it is effectively sold out of key AI memory products through 2026. Shares rose around 12% pre-market to about $250. The strong results offered relief amid ongoing AI jitters at Oracle, ORCL, Broadcom, AVG, and CoreWeave, CRWV. AI and crypto-linked equities edged slightly higher pre-market, highlighting the growing crossover, which is being fueled by the AI narrative. Update, Dec. 18. 1355 Coordinated Universal Time. Updates to add company earnings. Presentation and management discussion filings. Analysts estimate. U.S. Bitcoin ETFs see strongest inflows for over a month as BTC dominance hits 60%. By James Van Straten. Fidelity's FBTC recorded a top 5 inflow day as the ETFs took in a combined $457 million amid sharp BTC price swings. U.S. spot Bitcoin ETFs recorded $457.3 million in net inflows on Wednesday, the strongest daily intake since November 11. Fidelity Wise Origin Bitcoin Fund led with a $391.5 million inflow, which is a top 5 inflow day. For FBTC, Bitcoin dominance rose to 60%, its highest level in a month. U.S. spot Bitcoin exchange-traded funds, ETFs, posted their largest one-day inflows since November 11 on Wednesday, coinciding with a volatile crypto market during which Bitcoin BTC $87,188 rallied to nearly $90,000 before reversing and falling below $86,000. In total, The funds recorded net inflows of $457.3 million, most of which, $391.5 million, went into Fidelity Wise Origin Bitcoin Fund, FBTC. According to Farside data, this ranks as a top 5 inflow day for FBTC. BlackRock's iShares Bitcoin Trust, IBIT, also posted strong demand, registering inflows of $111.2 million. Bitcoin dominance, which measures BTC's share of the total cryptocurrency market capitalization, has climbed to 60%. This is the highest level since November 14, when Bitcoin was trading near $100,000. The largest cryptocurrency is currently trading around $87,000. Several macroeconomic events scheduled for today could further amplify volatility in Bitcoin price action. Bitcoin implied volatility, which reflects the market's expectation of future price swings based on options pricing, is currently just below 50 according to the Volmex Bitcoin Implied Volatility Index, BVIV. This level is historically low and suggests subdued risk pricing despite recent market moves. The Bank of England, BoE, is expected to cut interest rates by 25 basis points at 12 o'clock Coordinated Universal Time, lowering the benchmark rate to 3.75%. The European Central Bank, ECB, is expected to hold rates steady at 2.15%. Later in the day, both US and Japan are set to release inflation data, events that could increase volatility across global markets, including cryptocurrency. Bitcoin, BTC, price news, all over the place ahead of US inflation data. What next? By Omkar Godbal, AI Boost, US inflation data for November, expected to show a 3.1% increase in CPI, could influence Federal Reserve interest rate decisions. Bitcoin's price fluctuated between $86,000 and $90,000 in the last 24 hours, reflecting market uncertainty. US inflation data for November, expected to show a 3.1% increase in CPI, could influence Federal Reserve interest rate decisions. Crypto markets face additional pressure from potential MSCI index exclusions, which could lead to significant outflows. Crypto traders have had a tough time figuring out the market in the last 24 hours as Bitcoin's BTC $87,244 price swung wildly between $86,000 and $90,000. Things could get more exciting later Thursday with key U.S. inflation data for November coming up. This will give a fresh look at price pressures in the economy after the record government shutdown canceled the October data and left the Federal Reserve in the dark. What the data might show. The data is expected to show the headline Consumer Price Index, CPI, increased to 3.1% on a yearly basis in November, up from October's 3%. According to FactSet consensus estimates, core inflation, which excludes volatile food and energy prices, is forecast at 3.1%. That's still 1 full point above the Fed's 2% goal, which could embolden hawks at the Fed to talk down expectations of interest rate cuts. As of writing, markets anticipate at least 225 basis point Fed rate cuts next year. Expert view. This release is highly anticipated, largely because the recent government shutdown-related data disruptions left the Federal Reserve and the broader market flying partially blind. With the October report cancelled, this is the first comprehensive look at price developments in weeks. Dr. Muhammad A. El Arian is president of Queen's College, Cambridge University and part-time chief economic advisor at Allianz and chair of Gramercy Fund Management, said on X. He added that markets will be looking for two things. whether the disinflation trend in services has stronger legs and what remains of the tariff-driven price pass-throughs in good inflation. Why Bitcoin might react. Should the data confirm disinflation, it could prompt markets to price in additional rate cuts for 2026 dollars, galvanizing risk-taking in financial markets. Note, however, that BTC did not show a sustained bullish reaction to the jobs data released Tuesday, which showed jobless rate at highest since September 2021 dollars. Besides, the 10-year Treasury yield has held sticky above 4% in recent months despite Fed easing. This is partly due to uncertainty about inflation, as CPI has steadily risen from 2.3% in May to 3% in October. Longer duration yields like the 10-year incorporate investor bets on inflation trends, economic growth, and Fed policy paths. Higher yields signal stronger expectations in these areas and boost attractiveness of fixed income instruments, denting the appeal of risk assets. Against this backdrop, a hotter than expected inflation report could raise yields further, complicating matters for BTC bulls. Crypto challenges. Note that crypto-specific factors aren't helping either. For instance, MSCI's review of digital asset treasuries poses a major headwind. MSCI is reviewing the index eligibility of digital asset treasury companies, with potential exclusions for firms holding more than 50% exposure to crypto. If enacted, passive outflows could reach up to $2.8 billion United States dollars. The market Singapore-based Bitcoin price. BTC News. Bitcoin price. BTC News. Major whipsaw on Wednesday sends price back below $88,000. By Christian Sandor. It was a blink and you missed it rally as continued deflation in the AI trade sent the Nasdaq sharply lower, dragging crypto along with it. Wednesday's early U.S. rally in crypto suffered a near-instant reversal, sending Bitcoin back to the $87,000 area minutes after it had jumped above $90,000. Artificial intelligence favorites NVIDIA, Broadcom, and Oracle were sharply lower, dragging the Nasdaq down by more than 1%. Crypto markets suffered major whipsaw action in morning U.S. trade, with Bitcoin BTC $87,244 in the space of a few minutes, rallying from around $87,000 to above $90,000 and then back to the $87,000 area. The largest crypto was recently trading at $87,300. Down by 0.5% over the past 24 hours after being higher by more than 3% minutes earlier. The quick decline happened alongside sharp losses for artificial intelligence-related stocks, with NVIDIA, Broadcom and Oracle suffering 3% to 6% drops. The tech-centric Nasdaq was lower by more than 1%, helping to deflate AI sentiment. Blue Owl Capital was reported to have pulled out of funding a $10 billion deal for an Oracle data center in Michigan. The sudden price swings triggered over $190 million in liquidations across crypto derivatives markets in the past 4 hours. CoinGlass data shows the volatile action hit $72 million in long positions, seeking to profit from rising prices, and $121 million in shorts, betting on a decline. Shrinking liquidity at the margin is the main culprit behind Bitcoin's directionless trading, making it vulnerable to any outside pressure. Hunter Rogers, co-founder of the Bitcoin yield protocol Terahash, said in a note, "I think we're now seeing an exhausted market," he said. In that environment, even mild selling activity pushes the market lower. He added that BTC needs to hold the $80,000, $85,000 area as support. which could decide if fresh lows or a more sustainable rebound come next. Bitcoin shorts scramble for the exits as BTC price climbs. By James Van Straten. Oliver Knight. Bitcoin surged from an intraday low near $86,200 to reclaim $90,000, driven by aggressive spot buying and a wave of short liquidations. Over $110 million in Bitcoin short positions were liquidated in the past hour, according to CoinGlass, alongside a muted rise in open interest. The action points to spot-driven demand rather than leveraged bets driving BTC's surge to $90,000. Bitcoin's cumulative volume delta jumped $1,100% during the rally, signaling aggressive buying pressure not seen since early December. Global macro investors Julian Biddle says an oversold RSI reading supports a prolonged bull market, arguing the traditional four-year cycle has broken down as Bitcoin dominance climbs toward 60%. More than $110 million in Bitcoin BTC $87,244 short positions were liquidated as the price of largest cryptocurrency climbed to $90,000 from an intraday low of $86,200 on Wednesday. CoinGlass data shows the short positions were liquidated in the past hour, with the majority occurring on Bitcoin trading pairs. The price surge also coincided with a relatively subdued drop in futures open interest, suggesting that those in short positions either covered their positions buying spot, as opposed to leveraged products, to minimize risk or were liquidated. Bitcoin's cumulative volume delta (CVD) rose by $1,100% during the spike, indicating that aggressive buyers are overpowering sellers. That's behavior not seen since Dec. 1. Altcoins lagged Bitcoin's move for the most part as Bitcoin dominance climbed back towards 60%, a far cry from September when it reached as low as 56.7%. Over the past year, Wednesday has been the strongest performing weekday for Bitcoin. Data from Velo shows oversold RSI signals an extended Bitcoin bull market. Julian Biddle, the head of macro research at Global Macro Investor, argues that Bitcoin's recent price action is consistent with historical recoveries following oversold RSI readings, with the latest RSI breaking below 30, which occurred in September 2025. Biddle said the traditional four-year cycle is no longer valid, not because of the halving, but due to shifts in debt refinancing, longer-term maturities and liquidity dynamics. The current bull market will extend into 2026. Biddle said. Bitcoin price. BTC. News. Early U.S. surge above $90,000. By James Van Straten, Helena Braun, Christian Sandor. Surging metals prices and dovish comments from leading Fed chair contender Chris Waller were among the news items possibly boosting crypto prices. Crypto prices surged higher early in the U.S. trading day, sending Bitcoin, BTC, back above $90,000. Silver was ahead by nearly 5%, moving to a new record above $66 per ounce. Gold and copper were gaining as well, now the leading contender to be the next Fed chairman. Fed Governor Chris Waller suggested rates are 50 to 100 basis points above the neutral level. Crypto prices experienced a rare spike higher just after U.S. stocks opened for trade on Wednesday, taking Bitcoin BTC $87,107 back above the $90,000 level for the first time since last weekend. Among possible bullish catalysts were continued big gains in metals prices, with silver ahead about 5% to a new record above $66 per ounce. Gold and copper were also each higher by more than 1%. now leading in prediction markets to be the next chairman of the Federal Reserve. Current Fed Governor Chris Waller was on the tape with dovish remarks, suggesting the neutral Fed funds rate was 50 to 100 basis points below the level. He added that the U.S. now is close to zero jobs growth and that he doesn't expect a rebound in inflation. According to CoinGlass data, open interest fell from 669 kBTC to 665 kBTC while the price moved higher. This suggests shorts are covering rather than new leverage entering the market. The move looks like a deleveraging rally, driven by shorts closing positions instead of fresh longs piling in. All told, Bitcoin is now ahead about 3% over the past 24 hours. Bitcoin bulls could be forgiven for any excitement over what isn't that large of a move. Muscle memory over the past several weeks, however, has trained crypto fans to brace for sizable drawdowns during the U.S. market day, particularly around the open. Any sustainable change to that pattern would surely be notable. The major U.S. stock market averages are little changed early in their session, and the 10-year U.S. Treasury yield is lower by 2 basis points to 4.15%. Bitcoin, BTC, miner Hut 8 news. $7 billion Google-backed deal sends stock soaring. By James Van Straten. AI boost. The Bitcoin miner deepened its pivot into AI infrastructure with a $7 billion long-term lease. Backed by Google, Hut 8, Hut, signed a 15-year, $7 billion lease with FluidStack for 245 megawatts of IT capacity at its River Bend campus, with 3 5-year renewal options lifting potential contract value to about $17.7 billion. Google is providing a financial backstop for the base lease term, while JP Morgan and Goldman Sachs are expected to lead up to 85% project-level financing. Hut 8 shares are up around 20% in pre-market trading. Hut 8, Hut, shares are up 20% in pre-market trading after the company announced a landmark long-term AI data center lease with FluidStack. The Bitcoin and AI miner announced it has signed a 15-year, $7 billion lease with AI infrastructure firm FluidStack for 245 megawatts MW of IT capacity at its River Bend campus in Louisiana. It also grants FluidStack a right of first offer, ROFO, for up to an additional $1,000 megawatts of IT capacity as the campus expands. The agreement includes 3 5-year renewal options, increasing the potential total contract value to approximately $17.7 billion. Google is providing a financial backstop for the base lease term, significantly reducing counterparty risk. Hut 8 expects the deal to deliver $6.9 billion of cumulative net operating income over 15 years, or around $454 million per year. The River Bend facility is scheduled to begin commissioning in the second quarter of 2027, with project-level debt financing expected to cover up to 85% of total development costs. JP Morgan is acting as lead left underwriter, alongside Goldman Sachs. The announcement follows Cipher Mining's CIFR recent 10-year high-performance computing deal with FluidStack, which also included Google backing. Metaplanet, $3,350. To start sponsored ADR program to woo over-the-counter U.S. investors. By James Van Straten. AI Boost. The sponsored Level 1 ADR listing strengthens U.S. investor access, settlement quality and market credibility. The company said, Metaplanet's sponsored Level 1 ADRs will trade over the counter under the ticker MPJPY starting Dec. 19. The ADRs will offer U.S. dollar settlement, improved liquidity and standardized U.S. market infrastructure without raising new capital. Metaplanet shares rose 6% in Tokyo, trading to 443 yen, $2.80. Japanese Bitcoin treasury company Metaplanet, $3,350, said its American depository receipts, ADRs, will start trading DEC 19 on the U.S. over-the-counter OTC market under the ticker MPJPY. The securities are designed to improve access, transparency and operational efficiency for U.S.-based investors in the fourth-largest corporate holder of Bitcoin BTC $87,152. They will replace existing, unsponsored OTC trading under the MTPLF ticker, which lacked a formal deposit agreement and direct company involvement. The ADRs meet Level 1 issuance standards, meaning they are subject to the lowest level of compliance and regulation and cannot trade on regulated exchanges. Each ADR represents one common share and settles through standard U.S. securities infrastructure. Deutsche Bank Trust Company Americas will act as depositary, with MUFG Bank serving as custodian in Japan. The program is not intended for capital raising and does not affect the company's total shares outstanding. Even though the ADRs are limited to OTC trading rather than on NASDAQ or the NYSE, they offer materially improved settlement, much broader brokerage access, and significantly lower trading fees than unsponsored OTC instruments. Dylan LeClaire, head of Bitcoin strategy at the Tokyo-based company, said in a post on X, the structure removes key barriers for both retail and institutional investors, many of whom require compliant ADR frameworks due to regulatory and custodial mandates. He said, Metaplanet shares rose more than 6% in Tokyo to 443 yen, $2.80. Fed's latest liquidity program not necessarily the jolt Bitcoin BTC needs. By James Van Straten, Omkar Godball. There's a major difference between ensuring liquidity in short-term rate markets and the quantitative easing that juiced risk assets during COVID and after 2008. Financial panic. Alongside its rate cut last week, the Fed said it'd begin buying $40 billion as short-term treasury paper, exciting the crypto community. Digging into the details, one observer noted that this current operation is not the same as the central bank's QE programs that put such a charge into risk assets. The U.S. Federal Reserve cut interest rates by 25 basis points last week. But that may not have been the biggest news to Bitcoin BTC $87,853 bulls. The real surprise was the central bank's announcement to start buying $40 billion in short-term U.S. Treasury bills. That sparked a bullish frenzy in the crypto community. And why not? These purchases will expand the Fed's balance sheet, much as the $2020 COVID-era quantitative easing QE program and the post-global financial crisis maneuvers that fueled unprecedented risk-taking across financial markets, including in digital assets. Not so fast, suggests popular pseudonymous observer Conks, known for his in-depth macro insights. In a blog post published Monday, Conks argued that while the latest operation looks similar to QE, it's really not. The Fed action this time around aims to ensure healthy liquidity in money markets, where banks, corporations and investors lend and borrow cash for very short periods, typically overnight to a few months, to manage daily cash needs without locking up money long term. The program is not intended to stimulate the economy or markets, which is where previous QE programs were aimed. In short, the central bank is adding liquidity, not stimulus. For the moment, markets seems to agree. Bitcoin knee-jerked higher for a few minutes after the Fed announcement, but it's been headed lower ever since. now off about 7% since at $87,000. Quote, latest. Asset purchases will be devoid of any meaningful easing outside money markets, wrote Conks. Equities will need to rely on other forces to further climb the wall of worry. What's actually happening? The Fed's decision to buy short-term bills comes as bank reserves. The cash deposits of commercial banks at the Fed recently got too low. When reserves dwindle, interest rates banks charge each other overnight in the money market jump, causing financial tightening and threatening stability. The total amount of reserves fell below $3 trillion, the supposed ample level, in late October, causing a notable rise in those rates. The Fed's bill buying will boost cash reserves in the banking system, increasing liquidity and reducing the cost of interbank borrowing. This, in turn, ensures the smooth functioning of the money market. However, this does not really bring down longer duration interest rates, which is thought to be necessary to stimulate borrowing and investing in the economy and to galvanize risk-taking in markets. The QE implemented post-2008 and in 2020 involved the Fed buying longer-term Treasury notes and mortgage-backed securities, which pushed the 10-year yield to unprecedentedly low levels. Hence, it's not surprise that the Fed is calling its latest program RMO, Reserve Management Operations, rather than QE, preemptive strike. According to Conks, the RMOs seem to be a preemptive move against the possibility of stress emerging in coming months, especially in April when the Treasury faces a massive quarterly tax payment deadline. Around mid-April, millions of businesses and individuals pay estimated taxes to the IRS all at once, pulling out hundreds of billions in cash from money market funds and short-term funding systems as they sell assets or drain deposits. As revealed by Chair Powell in the latest FOMC presser, officials will imminently deploy reserve injections to build up a cushion against several incoming blind spots arising from a volatile TGA. The big risk centered around April's infamous tax day, Conks said. Following this year's interbank flows threatening to induce numerous blind spots, the Fed, now much closer to the system's lowest comfortable level of reserves, LCLOR, won't take any chances. In short, the Fed does not want to face another September 2019 dollars-like event when short-term borrowing rates spiked hard because reserves got too low, shaking the system. It is thus front-loading liquidity injections with $40 billion in bill purchases per month. What this means for markets. What looks like QE is really a maintenance operation aimed at ensuring smooth functioning of the financial system. The Fed doesn't appear to be aiming to juice asset prices or drive growth. It's making sure the pipes don't clog as reserves fluctuate. That said, the Fed action does eliminate the risk of sudden spike in interbank lending rates and panic in financial markets. In other words, it has removed a major uncertainty or potential headwind for risk assets, including Bitcoin. Moon Pursuit Capital launches $100 million market-neutral crypto fund. By Will Canny, AI Boost. The new quantitative vehicle aims to deliver risk-managed returns across crypto market cycles as the firm readies a global expansion push. Moon Pursuit Capital is launching a $100 million market-neutral quantitative crypto fund focused on lower volatility, risk-adjusted returns. The strategy combines an always-on algorithmic engine with opportunistic Bitcoin and altcoin trades layered on top. The firm's first fund has generated triple-digit returns since launch, including positive performance in a year of sharp drawdowns for digital assets. Moon Pursuit Capital, a crypto-focused investment firm, is launching its second fund, a $100 million market-neutral vehicle designed to deliver what it said are consistent risk-adjusted returns across digital asset cycles. The new fund is built around an algorithmic trading strategy that aims to stay market neutral and generate alpha without taking a strong directional view on prices, the company said in a press release Wednesday. A market-neutral strategy is an investment approach designed to generate returns that are largely independent of broad market movements. The goal is to eliminate or greatly reduce exposure to overall market direction, beta, so that performance is driven by the manager's asset selection, relative value judgments, or structural arbitrage rather than whether markets go up or down. The fund's core engine is supplemented by two overlays. Bitcoin BTC $87,239 accumulation at what the firm sees as cycle lows and short-term altcoin trades during periods of strong momentum, which are intended to boost returns and maintain a high Sharpe ratio through drawdowns. The Sharpe ratio is a common finance metric that measures how much excess return an investment generates for each unit of risk taken. We are structuring the fund across multiple jurisdictions to align with the needs of a global investor base. This multi-jurisdictional framework improves accessibility while enhancing tax efficiency, an important consideration in today's cross-border capital environment, said Utkarsh Ahuja, founder and managing partner at Moon Pursuit Capital. In emailed comments, the new fund builds on the first vehicle, which Moon Pursuit says is up more than 52% year-to-date and nearly 170% since its April 2024 launch. This performance shows that disciplined macro and quantitative strategies can still deliver strong returns in digital assets despite sharp volatility, the firm said. The first fund currently has $30 million in assets under management and is growing. The launch coincides with a broader expansion of the firm, which plans new offices in the US, Dubai and Singapore, and has added leadership roles across portfolio management, trading and fund administration. Moon Pursuit pitches the fund as a way for institutional allocators to access systematic, rules-based exposure to digital assets with tighter volatility controls at a time when investors are increasingly focused on risk-managed strategies. The rollout follows a volatile stretch for crypto. The market lost more than $40 billion in October, and many funds posted double-digit losses, while its strategy dropped about 3% but still remained positive on the year. Read more. Crypto investment firm Blockstream to acquire TradFi hedge fund Corbière Capital. Norway's sovereign wealth fund supports Metaplanet BTC plan ahead of EGM vote. By James Van Straten. Norges Bank, which holds a 0.3% stake in Metaplanet, voted in favor of for all 5 proposals ahead of the DEC 22 EGM. Norway's sovereign wealth fund, which holds about 0.3% of Metaplanet, voted in favor of all 5 proposals ahead of the company's DEC 22 extraordinary general meeting, backing its Bitcoin treasury strategy. The proposals introduce perpetual preferred shares and expand capital flexibility to support non-dilutive Bitcoin accumulation. Norway's Norges Bank Investment Management, NBIM, has endorsed Metaplanet's $3,350 Bitcoin BTC $87,308 focused strategy, voting in favor of all 5 management proposals ahead of the company's extraordinary general meeting, EGM, on DEC 22. According to a Bloomberg screenshot shared by Dylan Leckler, Metaplanet's director of Bitcoin strategy, NBIM, which is one of the world's largest sovereign wealth funds, managing about $1.7 trillion in assets, reported that it held approximately 0.3% of Metaplanet as of June 30. The 5 proposals approved by the fund are as follows: a reduction of capital stock and capital reserves, allowing funds to be transferred to surplus for dividends, share buybacks, or Bitcoin acquisitions without changing the number of outstanding shares. An increase in authorized shares, including new preferred classes, to enable future capital raises to support Bitcoin accumulation. The introduction of perpetual preferred Class A shares, known as MARs, which offer variable monthly dividends and ranks senior in the capital structure. The creation of perpetual preferred Class B shares, called Mercury, featuring fixed quarterly dividends, conversion options, and cash redemption features. Meta Planet are raising $150 million for third-party allotment to institutional investors. Authorization to issue Mercury shares to institutional investors to fund Bitcoin purchases. Metaplanet's common shares have risen about 8% year to date and are trading just over 400 yen, $2.60. How a stronger Chinese yuan, CNY, could lift Bitcoin, BTC, by Omkar Godbal. AI boost. The yuan has risen to its highest in over 2 months against the dollar. The strengthening Chinese yuan could create a more bullish environment for Bitcoin by influencing global money flows. A stronger yuan allows China to implement economic stimulus, potentially benefiting cryptocurrencies amid global economic shifts. The yuan's rise may lead to a weaker dollar, which historically boosts demand for dollar-denominated assets like Bitcoin. Bitcoin's BTC $87,189 price often dances to the tune of global money flows. And right now, a strengthening Chinese yuan, CNY, could be setting the stage for a more bullish backdrop for the cryptocurrency. According to one observer, the yuan traded at 7.043 per US dollar early Wednesday, its strongest level since October 8. It has strengthened about 1% this quarter and 4% from April's low of $3,504 per dollar. Historically, the yuan hasn't had much direct pull on BTC prices. Rumors have swirled for years that a weaker yuan pushes Chinese capital into crypto, and vice versa, but there's zero solid proof. However, swings in the yuan's value can still affect Bitcoin via macroeconomic channels and foreign exchange markets. According to newsletter service London Crypto Club, whose founder said the ongoing strengthening of CNY could bode well for Bitcoin's price. When the yuan is strengthening, it provides the cover for China to step up stimulus and easing to address the deflationary spiral they're battling, the founders of the newsletter service told CoinDesk. A strengthening currency makes imports cheaper, thereby putting downward pressure on domestic inflation. This, in turn, creates room for policymakers to provide economic stimulus. Coincidentally, calls for Chinese stimulus have increased alongside a stronger yuan, following a string of dismal retail sales and corporate investment data released early this week. This stimulus could compensate for the expected increase in borrowing costs in Japan and Australia, and the prospects of slower rate cuts by the Fed, thereby supporting risk assets, including cryptocurrencies. Now, coming to the foreign exchange part, a relentless rally in the yuan may prompt the People's Bank of China to intervene by buying dollars against the yuan. These dollars don't just sit idle. They're recycled or sold against other currencies to maintain a stable currency mix in the reserve portfolio, which holds trillions in major currencies, including the dollar, euros, yen, and others. This recycling operation ends up dragging the dollar index lower, and as it's well known, a weaker dollar tends to boost demand for dollar-denominated assets like Bitcoin and contribute to looser financial conditions, cheaper cash. Smoothing operations to slow the strength means increasing the money supply as they effectively Print CNY to buy dollars. Those dollars also get recycled, selling against other currencies to maintain stable FX weightings in their portfolio, founders said. This feeds broad dollar weakness. Added together, it all feeds into an easier liquidity environment which should be bullish for Bitcoin, they added. The coming weeks will show whether this backdrop can steady Bitcoin's slide and help the market find its footing again. BTC long-term holder supply hits 8-month low as this cycle breaks from historical patterns. By James Van Straten. Repeated distribution waves from long-term holders highlight how this Bitcoin cycle is breaking from historical norms. Bitcoin long-term holder supply has fallen to 14.34 million BTC, its lowest level since May, marking the third wave of long-term holders selling this cycle after earlier distribution around ETF approvals and the move to $100,000 after President Trump's election win. Unlike prior bull markets that saw a single blow-off distribution phase, this cycle is characterized by multiple LTH sell waves that have been absorbed by the market. Bitcoin BTC $87,189 long-term holder. LTH. Supply has fallen to an 8-month low of $14,342,207 BTC, a level last seen in May, which has coincided with Bitcoin falling almost 40% from its October all-time high. Glassnode defines a long-term holder as an entity that has held Bitcoin for at least 155 days, placing the current cohort cutoff around mid-July. So any buyer then and has held would be classified as a LTH. This decline marks the third distinct wave of LTH distribution in the current cycle since early 2023. The first wave occurred from late 2023 into early 2020. $4 following the launch of U.S. spot Bitcoin ETFs. When LTHs sold into strength as Bitcoin rallied from roughly $25,000 to a peak near $73,000 by March 2024. The second wave emerged later in the year when Bitcoin ran towards $100,000, driven by optimism surrounding President Trump's election victory. The market is now experiencing a third iteration of LTH selling as Bitcoin remained above $100,000 for much of the year. Why this cycle is different? This behavior stands in contrast to prior bull markets in 2013, $2017, and 2021, where LTH supply typically followed a single boom and bust pattern, bottoming near euphoric cycle peaks before gradually recovering. Instead, this cycle has seen repeated waves of distribution without a clear blow-off top. A dynamic highlighted by Alec, co-founder of Check-in-Chain, who noted that Bitcoin LTH spending this cycle is unlike anything seen in recent history, with the market absorbing a third sell wave remarkably well. LTH distribution remains one of the largest sources of sell-side pressure in Bitcoin and has been a key contributor to the nearly 40% correction from October's all-time high. Moon Pursuit Capital launches $100 million market-neutral crypto fund. By Will Canny. AI Boost. The new quantitative vehicle aims to deliver risk-managed returns across crypto market cycles as the firm readies a global expansion push. Moon Pursuit Capital is launching a $100 million market-neutral quantitative crypto fund focused on lower volatility, risk-adjusted returns. The strategy combines an always-on algorithmic engine with opportunistic Bitcoin and altcoin trades layered on top. The firm's first fund has generated triple-digit returns since launch, including positive performance in a year of sharp drawdowns for digital assets. Moon Pursuit Capital, a crypto-focused investment firm, is launching its second fund, a $100 million market-neutral vehicle designed to deliver what it said are consistent, risk-adjusted returns across digital asset cycles. The new fund is built around an algorithmic trading strategy that aims to stay market-neutral and generate alpha without taking a strong directional view on prices, the company said in a press release Wednesday. A market-neutral strategy is an investment approach designed to generate returns that are largely independent of broad market movements. The goal is to eliminate or greatly reduce exposure to overall market direction, beta, so that performance is driven by the manager's asset selection, relative value judgments, or structural arbitrage rather than whether markets go up or down. The fund's core engine is supplemented by two overlays: Bitcoin BTC $87,079 accumulation at what the firm sees as cycle lows and short-term altcoin trades during periods of strong momentum, which are intended to boost returns and maintain a high Sharpe ratio through drawdowns. The Sharpe ratio is a common finance metric that measures how much excess return an investment generates for each unit of risk taken. We are structuring the fund across multiple jurisdictions to align with the needs of a global investor base. This multi-jurisdictional framework improves accessibility while enhancing tax efficiency, an important consideration in today's cross-border capital environment, said Utkarsh Ahuja, founder and managing partner at Moon Pursuit Capital. In emailed comments, the new fund builds on the first vehicle, which Moon Pursuit says is up more than 52% year-to-date and nearly 170% since its April 2024 launch. This performance shows that disciplined macro and quantitative strategies can still deliver strong returns in digital assets despite sharp volatility, the firm said. The first fund currently has $30 million in assets under management and is growing. The launch coincides with a broader expansion of the firm, which plans new offices in the U.S., Dubai and Singapore, and has added leadership roles across portfolio management, trading and fund administration. Moon Pursuit pitches the fund as a way for institutional allocators to access systematic, rules-based exposure to digital assets with tighter volatility controls at a time when investors are increasingly focused on risk-managed strategies. The rollout follows a volatile stretch for crypto. The market lost more than $40 billion in October, and many funds posted double-digit losses, while its strategy dropped about 3% but still remained positive on the year. Read more. Crypto investment firm Blockstream to acquire TradFi hedge fund Corbière Capital. Norway's sovereign wealth fund supports Metaplanet BTC plan ahead of EGM vote. By James Van Straten. Norges Bank, which holds a 0.3% stake in Metaplanet, voted in favor of for all 5 proposals ahead of the DEC 22 EGM. Norway's sovereign wealth fund, which holds about 0.3% of Metaplanet, voted in favor of all 5 proposals ahead of the company's DEC 22 extraordinary general meeting, backing its Bitcoin treasury strategy. The proposals introduce perpetual preferred shares and expand capital flexibility to support non-dilutive Bitcoin accumulation. Norway's Norges Bank Investment Management, NBIM, has endorsed Metaplanet's $3,350 Bitcoin BTC $86,977 focused strategy, voting in favor of all 5 management proposals ahead of the company's extraordinary general meeting, EGM, on DEC 22. According to a Bloomberg screenshot shared by Dylan Leckler, Metaplanet's director of Bitcoin strategy, NBIM, which is one of the world's largest sovereign wealth funds, managing about $1.7 trillion in assets, reported that it held approximately 0.3% of Metaplanet as of June 30. The 5 proposals approved by the fund are as follows. A reduction of capital stock and capital reserves, allowing funds to be transferred to surplus for dividends, share buybacks, or Bitcoin acquisitions without changing the number of outstanding shares. An increase in authorized shares, including new preferred classes, to enable future capital raises to support Bitcoin accumulation. The introduction of perpetual preferred Class A shares, known as MARs, which offer variable monthly dividends and ranks senior in the capital structure. The creation of perpetual preferred Class B shares, called Mercury, featuring fixed quarterly dividends, conversion options, and cash redemption features. Meta Planet are raising $150 million for third-party allotment to institutional investors. Authorization to issue Mercury shares to institutional investors to fund Bitcoin purchases. Metaplanet's common shares have risen about 8% year to date and are trading just over 400 yen, $2.60. Bhutan pledges $1 billion in Bitcoin